Hello traders, what's going on? So today we are going to go through the market update. So today is 14th of September 2022. So this is a very important day because yesterday the CPI data just came out. And upon the releasing of the CPI data, we have the S&P 500 dropping 4.32%. And it is a negative 177 points drop, which is very huge. It's even bigger than the Jerome Powell Jackson Hole price action. Okay, so even by looking at it visually, even though the size of the candle is somewhat the same, right? You have to understand that yesterday it was a gap down. Not only it was a gap down, it was a big red candle also. And the interesting thing is that this entire price move yesterday, it kind of undo almost 3 days worth of rally. So we are going to dive into this a little deeper. Of course, if you are our Patreon subscriber, this price action is no surprise. It is literally what we expected. It's like when we look at it, we are like, okay, yeah, so like there is no surprise at all. Okay, so if you are wondering why the price action become like that and you are like totally lost, you are probably on the wrong side of the market. Okay, so let's dive into what is going on here. So normally, right, if you see the market respond in such a violent manner where no form of technical analysis seems to make sense. For example, you have what you call the three white soldier, everything gapping up, resistance broken. Then suddenly you have one big candle that kind of like ruin your entire technical setup. Okay, so normally when you have this kind of very big red candle that comes in right after high impact data release, so it is the CPI for yesterday case, and of course back in 26 August it was the Jerome Powell speech at Jackson Hole. These are the high impact situation that caused market to react violently. So when you see this form of reaction, right, it tells you one thing, and the thing is that market should not be rallying in the first place. Market have rallied too far above any form of reason, and the moment the new data come in, right, the market realize that, oh shit, we are wrong, and then it immediately readjusts. It immediately readjusts back. So when you look at this, right, truth to be told, the CPI number doesn't even matter at all, because when we look at the S&P price, S&P chart itself, right? On the Jackson Hole symposium, Jerome Powell mentioned a lot of pain incoming, this and that. They are going to be very aggressive. They will keep the restrictive federal fund rate for a period of time, blah, blah, blah. So Jerome Powell say all these things, and then market takes it very negatively, and then the S&P 500 crashes. But from that moment until this CPI data, between these two periods, there is no other data that calls for a rally. Yes, we do have NFP coming in, but even for the NFP, right, you realize that it wasn't a high impact enough to cause a shift in the direction. So when the NFP data came in, the market rallied a bit, but after that it went back down. And then during the short week for US, which was the previous week, the previous Monday was a US holiday. During the short week, market kind of start to rally, and it rallied quite aggressively. But the thing is, think about it. What are the fundamental driver for this rally? Is there anything in terms of fundamental or macroeconomic that you can think of to justify this rally? The answer is no, there isn't anything. And when you have a market rallying this aggressively without any form of fundamental driver, right, it is what we call irrational rally, market rally for no reason. And during our Patreon webinar, right? We even gone through some of the possible reason why this rally can take place, and we couldn't really find any reason except for a few things. Number one, the US dollar went down during these 4 days, which caused for a stock market rally. But the thing is, even then, it shouldn't be rallying this much. It was a weak justification lah. But aside from the US dollar going down, right? There wasn't anything that we couldn't find anything at all. It is as if the market is trying to fight the Federal Reserve again. But when the CPI data came out, the market immediately readjust back down to the so-called support level here lah. And that is the danger of irrational rally. If we see a rally without any form of macro drivers, fundamental drivers, you have to be very careful, because there are so many people out there calling generational bottom, generational buying opportunity, all-time high, S&P going to 5,000, 6,000, 7,000, 8,000. You have to be very, very careful. Being a bull is very easy. I can also call all-time high. I can say, okay, S&P going to all-time high, but I'm not going to give you a time frame. It can be 2 years from now, 3 years from now, but eventually I will be right, because market is always going up. All-time high is very easy to call. And if the market retraces when you make that call, right, you can say, oh, it is just retracing, but it will go to all-time high. Don't worry, don't worry. And eventually you'll be right. It will go to all-time high. But the thing is that you cannot get caught in this kind of market breakdown lah. Okay. And of course, if you are a dollar cost averager, you are just looking to dollar cost average long term, then none of these matter to you lah, because market will eventually reach all-time high. So you just go and do your dollar cost averaging. Don't need to pay attention to whatever that's going on. But if you are a short-term trader, right, definitely you want to take advantage of all the downside and the upside also lah. Okay. So the thing is that if you think about it, right, let's say the data came out like this, and a lot of people will be arguing about the data. It's like, oh, last month it was 8.5, now it is 8.3. Inflation actually went down. How come market crashed, this and that? But if you think about it, right, let's say the market did not rally. The market did not rally for no specific reason. The market kind of like just went sideways, and the CPI data come out. And if market was sideways when the CPI data came out, right? Even if the data is like what you are seeing now, 8.3, what the market will probably does is that it will just remain sideways, or maybe go down a bit, go up a bit. It will be flat lah. But the fact that it rarely irrationally is the reason why it came back down. So as I mentioned previously, right, when you see this kind of thing, the question to ask is not why the market crashed. The question to ask is, why is it rallying in the first place when there wasn't any form of fundamental or economic drivers? But let's dive a little deeper into the CPI data, because even though we have a year-over-year decrease in the CPI, where 8.5 went down to 8.3, we do have a month-over-month increase. Previously, it was 0%, meaning from June to July, right, the inflation was stagnant. There wasn't any inflation at all. There wasn't any increase in inflation. But from July to August, there was a 0.1% increase in inflation, where the consensus was decreased. So this is actually quite bad, even though 0.1 might not seem a lot, right? On a month-to-month basis, it is actually quite significant to see this increase in inflation lah. But the more important one is you can see the core CPI going up. The month-over-month core CPI going up by 0.6%, and the core CPI year-over-year went up by 6.3%. So core CPI is if you exclude energy and food, because Federal Reserve always like to say that inflation is transitory because of high energy prices, high food prices, because Russia invade Ukraine, and then all the soft commodity supply chain, this and that. So once the issue is over, everything should be coming back down. But the thing is, the data is pointing towards a different direction, because now you have the CPI coming down on a year-over-year basis, mainly because the gas prices are down, the energy prices are down, which is good, because if you look at the oil prices, the oil price is now below the pre-invasion level. That is why we see the gas prices are coming back down right now. But if you look at the core data, which doesn't include energy and food, which the Federal Reserve sort of pointing the fingers towards the Ukraine invasion, right? The core reading is up. So the core reading has nothing to do with energy or food or supply chain or whatever. The core reading, meaning there is inflation embedded within the US economy that is not affected by external factor already. Okay, meaning the oil prices can go down to $70 per barrel, $60 per barrel, but the inflation is still there. It's still there. So this is very, very alarming. And the core prices is going up despite 2 rounds of 75 basis point hike. Think about it. US have not hiked even 50 basis point hike since the housing crisis. All they have done is 25, 25, 25. When Federal Reserve did a 50 basis point hike for the first time, for first time in a long while, in 2022, right? It was like a big hoo-ah. And then inflation didn't go down. And then they raised by 75. Inflation didn't go down. And then they raised by another 75. Okay, inflation came down for 1 month. And then Jerome Powell declared that inflation is, sorry, not Jerome Powell. Joe Biden declared that inflation is 0%, celebrating for 1 month. And immediately after that, we have the core inflation going back up again. So this kind of tells you that you can't really point the finger at Russia anymore for the inflation issue, because now gas and food prices are no longer your issue already. The prices are going down to pre-invasion level. You can't point the finger at them already, but there are a lot of other things that is going up. Okay, so let me just show you a bit of data from the Bureau Label of Statistics from US. So this is actually the government website, okay? So you can go and find this for yourself. So I'm looking at the month-over-month inflation item. You can see that in August, right? Inflation went up by 0.1%. So this is the number that you are seeing here. This is the number that you are seeing right here. Okay. So these are in percentage points. So what you need to first realize about percentage point is that, yes, sometimes the percentage point can be big, but the thing is, if your underlying weightage is small, then the big percentage change doesn't matter. It doesn't have really big effect. For example, 90% of $1 is only 90 cents. Okay, but 9% of $100 is $9. So that kind of logic. Okay, so don't blindly read data and then blindly conclude certain things. You need to sit down and think a bit about what all these numbers means. So you can see that for all items, right, inflation went up by 0.1%. So this is not the core inflation. This is actually the CPI, which include energy and food. So you can see those that are going down is your energy, your gasoline, and your fuel. Okay, and in fact, in August, right, the decline accelerate. In July, it went down by minus 4.6%. August is 5%. It went down even higher, and even for gasoline and oil, right, you can see it's going down 10%, whereas previously July it went down by 7%, which is a very good thing, which is an extremely good news. Gas prices going down, and I'm not sure if I showed this chart before. This is the US retail gas price, and you can see that the gas price has been going down like almost every day since June, and June is the bottom. bottom for the stock market, at least lah, temporarily lah, I would say. I don't think June bottom is the real bottom lah, okay? So then that is where the good news end, because almost everywhere else things are going up at a faster pace. Look at electricity, 1.5, and utility gas services go from negative 3.6 become plus 3.5%. And your food is actually okay, food also went up slightly. Food also went up slightly, 0.8%, 0.7%. And everything outside of food and energy, right, is all going up except for used car. Is this used car? Yes, except for used car and trucks, everything is going up. Shelter went up 0.7%. So now shelter, it only went up by 0.7%, but the thing is, shelter is probably the highest weightage of your, will be the highest weightage of your expenditure every month, okay? So a 0.7% increase in shelter is actually a big deal, a big deal compared to like a minus 10% in gasoline, because I guess your expenditure on gasoline will not be as much as your shelter, because for example, shelter rent, you are paying as much as about 30 to 40% of your monthly income, like that. I'm not sure what's the condition in US, but I'm guessing it is somewhere around there. So now the bad news is that, as mentioned, right, previously, we always have the benefit of doubt to say that it is the high gas prices, it is the high oil prices, it is the high food prices, that's why inflation is high. But now that reasoning is gone, that excuse is gone, how do you bring down prices of shelter? How do you bring down price of transportation service, new vehicle, apparel? How do you bring down the price of all these things? You cannot count on things like all prices coming down anymore. There's only one way to bring down those core prices, meaning non-energy, non-food, and that is to increase the rate hike, increase the pace of the rate hike, increase the federal fund rate. So perhaps maybe we are looking at 3.4% federal rate hike for this year. Currently, we are still at 2.5. So there's a full 1% that is need to be hiked. But perhaps now with this data, right, it seems like maybe 3.5% federal fund rate might not be enough. Maybe Federal Reserve is gonna increase the projection further up to 4%, meaning they need to raise another 1.5%. So perhaps that could be the reason why market is crashing so hard, because it is not just looking at whatever data you see in front of you. Market is pricing in all the future events also. Market is realizing that, hey, shit, fuel and food are not the cause of inflation already. There are other bigger contributing factor to inflation, and for all these factors, right, you have to raise the interest rate by perhaps even more aggressively lah. Okay. So with that said, right, my view as always never changed. For since the beginning of February, I have been a bear, and I am still a bear. I still have a lot of short position open. If you have been following our macro report, macro Tuesday, macro Monday, right? I do share what is my overall position, whether if I am net short or net long or neutral or whatever. And within the past 2 weeks, right, my portfolio have slowly changed from a neutral position into a net short position lah. So I was neutral around this period before the Jackson Hole, and after the Jackson Hole speech, I changed to net short, and right now I am continue to keep my net short portfolio. Okay, so going forward, the bias is on the downside. Nothing have changed. We have a lot of people calling bottom of a lot of different nonsense. I have people calling Facebook have bottom, but Facebook actually broke through the support yesterday. It is something that we shared publicly also as early as 1st of September. We share why we don't think Facebook is bottoming, and you have to be very, very careful. And of course, there are a lot of other stuff that we have short position on now, okay? But surprisingly, we have the we have the fertilizer company and the the fertilizer company kind of like surviving this crash lah, and some of the lithium company also surviving the crash. So we may explore this further in our Patreon. We shall see how. But aside from those, everything else is diving down. Even Apple managed to go back to the bottom, go back to this recent bottom in just one day. Okay, so I know being a bear is hard because there's so many bulls around, and and of course, there are also a lot of people. I'm not gonna name who, but there are a lot of people who suddenly went into investor mode, from trader become investor. And as an investor, right, you can always call all-time high because you're gonna hold 10-year, 20-year. You can always sit down and call all-time high every day without any repercussion. But as trader, right, that is not what we want, because as trader, what we want is we want to capture both the downside and the upside. If you are an investor, you will be sitting around now doing nothing except for dollar cost averaging while you watch your entire portfolio become red and red. But as a trader, right, we want to capture this downside also, and when market recover, we will capture the upside also. But unfortunately, right now, market is on the downside. So one thing very important, we have another high impact event coming up, which is next week, on Tuesday 20th, I believe, which is the FOMC decision. So during this period, right, we may have another big move. So I do believe that the downside will continue. But once again, right, the market expectation is very, very important, because if, let's say, S&P decide to go down very aggressively in the next 5 days, it just gap down, and then before next Tuesday, right, the price is already at like 3,600, for example, okay? Then next week, when the FOMC decision come out, then no matter what the decision is, market can rally because it has already gone down by quite a bit. Okay, and let's say if for some reason market decide to recover, okay, market decide to recover for some unknown reason, and then because of this, next week market can actually go down very big because it rally for no apparent reason. So these are the things that you need to be very careful of. What is the market price action is like? Because in our Patreon webinar, we specifically highlight that the fact that market is rallying into CPI data release is a very bad thing, because if the data come out to be quite bad, right, it's gonna crash like there's no tomorrow, and that is what exactly happened. Okay, so we have to be very, very careful. Do not get carried away, especially when you see people calling things like we are gonna hit 5,000, S&P gonna hit 5,000, 7,000, 8,000, and likewise, don't also get affected by all the perma bear who is calling for S&P to go to 2005, which is ridiculous, which is equally ridiculous lah. Okay, so on one hand, we have all the perma bull calling 8,000. Then on the other end, we also have the perma bear who have been bearish since like 2015, like that. They're calling market to drop to like 2005, like that. So you have to be wary of both sides lah. Okay, so that's all I have for today for the Patreon folks, right? We will go through much more in depth with our trades on coming Friday and coming Saturday lah. But for everyone else, we do hope that this session kind of give you some form of insight. Please, please. The market right now is driven by macroeconomics, inflation, Federal Reserve fund rate expectation. All these are the drivers, not your technicals. Whatever nonsense line that you draw on your chart doesn't matter, because whatever line that you draw, one bad data come out, that line is gone. Okay, technical have no place in today's market. They can use as a confirmation if you have proper fundamental driver, but without the macroeconomic driver, technical is not gonna do you any good. That is the reason why we are relying a lot of fundamentals during this period, because that is what driving the market. Okay, guys. So your support, your resistance, this and that, all the lines that you are drawing on the chart, throw them out of the window. They are not gonna help you, because one message from Jerome Powell, your support is gone. Then what for you draw the line there? Correct. Okay, guys. Have a good week. And if you feel that you are lost or what, do consider joining our Patreon, because so far while our individual trades, we may have get caught during some of the bear market rally, but overall for the entire year, we are still correct in the sense that we are still on the downwards trajectory lah. We are still on the short bias lah. And of course, once we see enough evidence for a bull market, we will definitely go along. Okay, guys, have a nice day.